We are diving deep today into the automotive sector, and specifically, we're putting the Talk Tickers methodology to work on Ford Motor Company. That's ticker symbol F.
Right.
And we have a massive stack of sources on the table right in front of us today. We've got their Q1 2026 earnings call transcript, the accompanying financial models, management's updated forward guidance, and a few key Wall Street analyst notes that came out immediately after the bell.
Yeah, and our mission for this deep dive is to really just synthesize all of those documents and cut right through the corporate PR speak.
Exactly.
We want to translate that heavy Wall Street jargon into plain, actionable language so you can figure out if Ford's latest, massive quarter is a genuine operational turnaround or if the numbers are playing tricks on us.
Right.
Ultimately, we want to deliver a clear, opinionated thesis on whether this stock is a buy, hold, or sell for your portfolio.
And to get there, we really have to start with a hook.
Yeah.
Because, at first glance, the headline numbers are just staggering.
They really are.
Ford just posted a jaw-dropping $3.5 billion in adjusted earnings for the first quarter. You see that headline flash across your trading terminal, and the immediate instinct is to think, wow, they're absolutely crushing the market.
Sure.
But reading an earnings transcript is a lot like buying our used car or maybe a historic mansion.
Right, yes.
You walk through the front doors, and the newly renovated foyer is just stunning. The lighting is perfect, the fresh paint looks incredible, and you're tempted to just hand over the check right then and there.
Oh, absolutely.
But you cannot do that. You have to hire an inspector to go down into the basement with a flashlight, tap on the foundation, and look for the hidden termite damage or the leaky pipes the seller's hoping you just ignore.
And the foundation of that $3.5 billion number definitely requires an inspection because there is a massive $1.3 billion asterisk attached to it.
Yeah, that's huge.
It is. That one-time benefit completely skews the reality of their quarterly performance if you don't adjust for it.
I do want to get into that asterisk in a second, but I actually want to start with something that jumped out at me from the raw data, which is the sheer mechanical reality of their production.
Okay, let's hear it.
So, Ford posted $43.3 billion in Q1 revenue. That is a 6% increase year over year. And this is the crazy part, that their global vehicle volume, like the actual physical number of cars and trucks rolling off the assembly lines and into customer driveways, that declined by nearly 4%.
Wow.
Yeah. They are making more money by manufacturing fewer products.
Yeah.
How does that manufacturing math actually work out in their favor?
Well, it comes down to a fundamental shift in how legacy automakers view their factory footprints. For decades, the industry was obsessed with market share and volume.
It's just pumping out cars.
Exactly. You wanted to build as many units as possible to keep the factories running at 100% capacity because an idle factory is just a massive capital drain.
Right.
But what Ford is doing now is they're intentionally slaughtering their own low-margin vehicles. They've phased out the Escape in North America. They killed off the Focus in Europe.
Oh, wow.
Yeah, and those were cars that sold in massive volumes, which looked great on a spreadsheet tracking total units, but the actual profit margin on a base model Escape was razor thin.
So they were just moving metal to keep the lights on at the factory, basically.
Precisely, and that's exactly the opposite of what you want in a high inflation environment. So they made the difficult choice to sell fewer cars overall, but they replaced those low-margin vehicles on the assembly line with, F-Series trucks, commercial transit vans, and large utilities like the Explorer and Expedition.
Which are way more expensive.
Way more. A fully loaded F-150 might carry a profit margin of 15 to 20%, whereas an entry-level sedan might scrape by at maybe 2 or 3%. Mm-hmm. So they are trading sheer volume for immense pricing power.
I understand the unit economics of selling a $70,000 truck versus a $25,000 sedan, but I have to challenge the long-term viability of this.
Fair enough.
Shrinking your overall volume to boost your revenue, it feels like a neat corporate trick that works right up until you run out of cheap cars to cancel. Like if you shrink your footprint too much, you lose market share, and more importantly, you lose the massive scale you need to negotiate favorable pricing with your tire suppliers, your steel providers, and, your chip manufacturers.
Yeah, and that is the multi-billion-dollar tension at the heart of their current strategy. If you become too niche, you lose your purchasing power. But management's counterargument is that they aren't merely shrinking into a niche, they are reallocating their scale.
Reallocating it how?
Well, the factory space, the robotics, and the engineering capital that used to be tied up in the mass market escape, that's all being directly ported over to high-margin off-road trims and commercial fleet vehicles. They are trying to prove they can maintain supplier scale by dominating specific, highly profitable segments rather than trying to be everything to everyone.
Which brings us back to the profitability metrics.
Yeah.
And that massive asterisk we mentioned earlier. Let's look at the EBIT breakdown.
Let's do it.
And for anyone tracking the terminology, EBIT is earnings before interest and taxes. We use this metric because it isolates the core operating profit of the business before the accountants step in to handle debt payments and tax liabilities.
Right.
So adjusted EBIT came in at that staggering $3.5 billion. But CFO Sherry House noted right at the top of the call that $1.3 billion of this was a one-time IEPA tariff benefit.
Yeah, and whenever you hear one-time benefit on an earnings call, your ears should immediately perk up because Wall Street just instantly strips that out of their valuation models.
Literally.
Right. In this case, the IEPA tariff benefit refers to the import-export pricing adjustments. Essentially, Ford had been paying heavy punitive tariffs on certain raw materials and components flowing across borders between March 2025 and February 2026.
Okay.
And a recent trade ruling or adjustment reclassified those components, so that resulted in a retroactive refund, or like an accounting credit back to Ford for the money they already spent.
So it's essentially a massive rebate check clearing in their bank account. It's fantastic for their cash position, obviously, but it has absolutely nothing to do with their ability to build and sell cars efficiently in the first quarter.
That is the critical takeaway. And about $700 million of that benefit was applied to the Ford Blue segment. That's their traditional gas vehicles. And $500 million went to Ford Pro, their commercial division.
Got it.
So if you subtract that $1.3 billion windfall, Ford's core adjusted EBIT, the actual profit from running the business, was $2.2 billion.
Now, I will say, $2.2 billion is still a very robust operational number. It shows the core business is actually healthy. But framing matters.
It really does.
It fundamentally shifts the narrative of the quarter from a, historic expectation-shattering blowout to just a very solid, fundamentally sound performance. And that distinction is super vital when we look at the cash flow, because the free cash flow numbers gave me absolute whiplash.
Yeah, the cash flow statement is where the real drama of this quarter lives.
Right. We just established they had $2.2 billion in core operating profit. But their adjusted free cash flow for the quarter was a negative $1.9 billion.
Yeah.
I need you to translate this for the listeners. Because to a retail investor, seeing a highly profitable company simultaneously burn almost $2 billion in cash in a single quarter looks like a massive accounting error.
I know, it does. But it highlights the difference between accrual accounting and actual cash in the bank. You can book a profit when you sell a truck to a dealership, sure. But if you have massive bills coming due at the exact same time, your cash balance drops.
So what were the bills?
Well, CFO Sherry House attributed this cash burn to working capital changes and timing differences. And when we decode that corporate phrasing, it points to 3 distinct real-world events.
Okay.
First, the first quarter is traditionally when automotive companies pay out annual performance bonuses and profit-sharing checks to their union employees for the previous year's work. That is hundreds of millions of dollars just walking out the door all at once.
Okay, so the liability was on the books last year, but the actual cash leaves the bank account in Q1.
Exactly. And furthermore, they were aggressively managing inventory drawdowns, paying suppliers for parts that were ordered months ago. But the third factor is the most alarming, and it's totally unique to this specific quarter.
Oh.
Ford is currently navigating a severe supply chain crisis with their primary aluminum provider, a company called Novelis.
The Novelis disruption. This was heavily discussed by the analysts on the call. What exactly happened here, and why is it burning so much cash?
Right, so Novelis operates the primary hot mill that supplies the specialized aluminum sheets Ford relies on. Remember, Ford made a massive controversial bet back in 2015 to switch the F-150 body from steel to military-grade aluminum to save weight and improve fuel economy.
Right, the aluminum body F-150.
Yeah, and that bet paid off, but it made them highly dependent on specialized aluminum processing. A hot mill literally takes massive multi-ton aluminum ingots, heats them to extreme temperatures, and rolls them through presses until they are thin sheets ready for stamping.
Sounds intense.
It is. And the Novelis hot mill went offline due to an industrial disruption. Without that aluminum, Ford's most profitable assembly lines basically grind to a halt.
So To prevent the factories from shutting down, Ford just had to open the checkbook and spend whatever it took to source aluminum from anywhere else on the planet.
Exactly. In Q1 alone, Ford burned $300 million on what management categorized as temporary costs. In reality, that means paying exorbitant spot market prices for raw aluminum. It means paying premium rates for expedited freight, like literally putting heavy metal on airplanes or rushing it via cross-country trucking instead of utilizing cheaper rail networks. It also means securing temporary, unplanned warehouse space to store these alternatively sourced materials and paying unexpected import tariffs to get foreign aluminum into their U.S. plants.
Management sounded incredibly confident on the call, though. Like Chief Operating Officer Kumar Galhotra stated that the Novelis hot mill is scheduled to restart in May.
He did.
And he projected that once they are back at full capacity, all of these emergency freight and premium material costs will evaporate, which he says will result in a $1 billion net improvement in earnings over the back half of the year.
Well, the math checks out, provided the timeline holds perfectly.
But that is where I have to raise an eyebrow.
Yeah.
You know, they insist the May restart is locked in and the industrial enablers are on track.
Yeah.
But in the very next breath, they kept assuring analysts that they have robust contingency plans in place.
Right, yeah.
They mentioned securing additional alternative aluminum capacity just in case the relaunch stumbles. Are they subtly downplaying the execution risk here? Because restarting a massive industrial hot mill isn't like rebooting your home router.
Not at all. And your skepticism aligns perfectly with the tone of the analysts during the Q&A portion of the call. When management emphasizes contingency plans that heavily, they are tacitly acknowledging a high degree of execution risk. Bringing a hot mill back online involves calibrating immense thermal and mechanical stresses. There is the initial restart, and then there is the lengthy ramp-up period to achieve the required production volume and quality standards.
Which takes time.
Right. If that ramp-up takes 3 months instead of 3 weeks, Ford will be forced to continue burning cash on expensive alternative aluminum throughout the entire summer. That promised $1 billion improvement could easily turn into a persistent margin drain.
It is arguably the biggest mechanical leak under the hood of this company right now.
Yeah.
However, I do want to pivot from that massive headwind to what is undeniably a spectacular tailwind. Let's dig into the segment results, specifically Ford Pro.
Yes.
Because when I was reviewing the transcript data for their commercial division, I legitimately had to double-check the header to make sure I wasn't reading an earnings report for a Silicon Valley enterprise software company.
I know. The transformation of Ford Pro is the most underreported story in the automotive sector right now. The standout data point is that Ford Pro now boasts 879,000 paid software subscriptions. That represents a 30% increase year over year.
Nearly 1 million paid subscriptions. I need to understand the mechanics of this, because if I own an HVAC repair company and I buy a fleet of 10 Ford Transit vans, I assume I'm just buying metal and an engine. What exactly am I subscribing to that gives Ford a recurring monthly revenue stream?
Well, you are subscribing to an ecosystem called Ford Pro AI, which is a suite of digital telematics and fleet management tools. Think about the biggest costs for an HVAC company. It's fuel, vehicle downtime, and maintenance.
Right.
Ford Pro AI uses large data models pulling information directly from the sensors inside those 10 vans. As a fleet manager, you get a dashboard that uses predictive algorithms to tell you that, say, van number 4 is going to have a transmission issue in approximately 800 miles.
Oh, that's incredibly useful.
Right. It allows you to schedule maintenance on a weekend rather than having the van break down mid-delivery on a busy Tuesday.
That is massive. Unplanned downtime is pure poison for a service business.
Exactly. And the software also tracks real-time fuel consumption. It coaches your drivers on excessive idling or harsh braking to improve efficiency and actively optimizes daily driving routes based on traffic and, battery charge levels if you are running electric transits.
So they're essentially selling an enterprise resource planning software that just happens to be wrapped inside a commercial van.
It is the exact playbook Apple executed with the iPhone. Apple generates a fantastic hardware margin when they sell you the physical phone, right? But the true, sustainable, high-margin wealth comes from the recurring revenue of the App Store, iCloud subscriptions, and Apple Music.
I see.
Ford is transitioning commercial fleets from a one-time hardware purchase into a sticky, high-margin recurring revenue model.
And the revenue figures CEO Jim Farley shared are just staggering. Across the enterprise, Ford generated $15 billion in software and physical services last year, and they were projecting that 15 billion baseline to grow by nearly 8% annually through the end of the decade.
Which is huge.
But you mentioned physical services, which is the other half of this Ford Pro equation. Farley pointed out that nearly 20% of all Ford repairs are now executed remotely, completely outside of the traditional dealership infrastructure.
Right, and this is a radical disruption of the traditional dealer mechanic model. Ford has deployed a massive fleet of mobile service vans.
Mobile service vans?
Yeah. If one of your HVAC vans needs a software update, a brake job, or a minor component replaced, you don't lose a day of revenue driving it to a dealership and waiting in the service lane. A Ford mobile mechanic drives to your company lot at like 9:00 p.m., services the van while your driver is asleep, and it's ready to go the next morning.
If I run a business, I am absolutely willing to pay a premium for that convenience.
Exactly, because it maximizes your uptime, which is the singular metric that defines profitability for a fleet manager. And even more aggressively, Ford is expanding their multi-make aftermarket parts catalog.
Wait, multi-make?
Yeah, they want their mobile mechanics to service your entire fleet, even if half your vans are manufactured by Mercedes or Chevrolet. And Jim Farley made a brilliant point on the call service revenue is inherently anti-cyclical.
Okay, let's unpack that term for the listener. What makes this anti-cyclical?
Well, in a booming economy, businesses buy brand new vans. That's cyclical growth. But when a recession hits, businesses freeze their capital expenditures. They stop buying new vans and instead choose to run their existing older vans for an extra 3 or 4 years.
And older vans break down more often.
Exactly. Older vans require significantly more maintenance, parts, and software diagnostics to keep running. So precisely when Ford's new vehicle sales dip due to the economy, their high-margin service and repair revenue actually accelerates. It creates an incredible financial buffer against the traditional automotive boom and bust cycle.
That strategy is brilliant. So Ford Pro is dominating commercial software. Let's shift over to the retail consumer side, Ford Blue. That's the division that handles traditional internal combustion engines and hybrids.
Right.
They posted $1.9 billion in EBIT, which is their highest Q1 share of total company revenue in 5 years. And they are achieving this through what I'm calling the trim strategy. They've realized they are no longer just selling transportation. They are selling a lifestyle aesthetic.
Yeah, and this ties directly back into our earlier discussion about shrinking volume to boost revenue. Ford showed a really striking statistic. Their high-end off-road performance trims, like vehicles heavily modified with the Raptor and Tremor packages, those now account for 25% of all their retail sales in the United States.
1 out of every 4 retail vehicles sold is a specialized off-road performance trim. That's insane.
And the profit margins on a Raptor are exponentially higher than a base model XL work truck. The engineering development cost is already baked into the base chassis, so all the premium suspension upgrades and aesthetic styling they charge top dollar for, that flows almost entirely to the bottom line. Furthermore, the data showed that in the first quarter, the F-150 didn't just have the highest retail market share and the highest average transaction price in its segment. It also required the lowest incentive spend per unit compared to its competitors from GM and Ram.
And that is the ultimate indicator of pricing power. Let me just explain for the listeners. Incentive spend is Wall Street terminology for putting cash on the hood. When a car isn't selling, a manufacturer offers a $3,000 rebate or 0% financing just to bribe the consumer into buying it.
Right.
The fact that Ford is offering the lowest incentives means consumers are willingly paying the sticker price. They're actively seeking out these high-margin lifestyle products.
Absolutely. And Ford is very smartly using hybrid powertrains as a bridge within this lifestyle strategy. Like the Ford Maverick and the hybrid F-150 are currently the best-selling hybrid trucks in their respective classes.
What I love about their hybrid approach is that they aren't marketing it based purely on saving the polar bears or like eking out an extra 3 miles to the gallon.
Yeah.
They are tying the electric battery directly to tangible lifestyle utility. They heavily promoted Pro Power Onboard, which essentially utilizes the hybrid battery to turn your F-150 into a rolling heavy-duty generator.
The utility of that feature is a massive selling point. If you are a contractor on a job site without active grid power, you can plug your table saws directly into the bed of your truck.
That's incredible.
Right. Or if you are tailgating at a football game or camping off the grid, you can power a massive television and a refrigerator for days It provides the consumer with a compelling, immediate reason to adopt an electrified powertrain, but without subjecting them to the range anxiety and, the charging infrastructure headaches associated with a full EV.
Which is a necessary stopgap because, frankly, we have to address the elephant in the room. Ford Model E.
Oh, yeah.
Their dedicated electric vehicle division posted a severe loss of $777 million for the first quarter.
Yeah, that hurts.
Now, management spun this as a positive, noting it represents a 35% improvement in their Gen 1 EV losses compared to last year, meaning they are losing less money on every Mustang, Mach-E, and F-150 Lightning they sell, largely by aligning their supply with the actual, cooling consumer demand. But a nearly $800 million loss is still a gaping wound.
It is an immense capital drain. But Ford is fundamentally re-engineering their approach to electrification rather than just accepting those losses.
Well, so.
They have quietly isolated a dedicated, highly specialized engineering team operating as a Skunk Works project tasked with developing a radically new universal EV platform, or UEV. This platform is slated to launch in 2027 out of their Louisville, Kentucky assembly plant.
So when an automaker uses the term Skunk Works, they are deliberately invoking aerospace terminology to signal that this team operates outside the sluggish bureaucratic corporate structure.
Right.
They're given a mandate to break the rules and innovate quickly. What exactly is this UEV team doing differently to stop the financial bleeding?
Well, their entire mandate is radical cost reduction. The current generation of EVs are simply too expensive and complex to assemble profitably. So, the Skunk Works team is aggressively integrating megacasting supplier techniques.
Megacasting, like Tesla.
Exactly. For context, a traditional vehicle chassis is comprised of dozens, sometimes hundreds, of individual stamped steel components that have to be meticulously welded and bolted together by a massive army of robots.
Right.
Megacasting involves injecting molten aluminum into a gargantuan press to cast the entire front or rear section of the vehicle as a single unified piece of metal.
Oh, wow. So it completely eliminates the need for hundreds of parts and thousands of welds, and it must drastically shrink the physical footprint required on the factory floor.
It fundamentally changes the unit economics of the vehicle. And alongside megacasting, this team is writing their own proprietary software architecture from the ground up, rather than cobbling together code from 50 different third-party suppliers.
That makes a lot of sense.
And they are utilizing advanced physics-based cost modeling to simulate exactly how much a component should cost to manufacture down to the molecular level, allowing them to ruthlessly negotiate with suppliers.
What fascinates me most about this Skunk Works project isn't just the EV applications, but the cross-pollination. Jim Farley emphasized that they are taking the structural breakthroughs from this isolated team and porting them directly back into their mainstream internal combustion and hybrid vehicles.
It really demonstrates a major organizational shift. Ford recently collapsed their internal silos. They established a unified end-to-end organizational structure that directly integrates their advanced technology and software teams with their traditional global industrial system.
So the software engineer writing code in Palo Alto is actually communicating with the factory floor manager in Dearborn. If the UEV team utilizes physics-based modeling to discover a method to route a wiring harness using 15% less copper, that innovation doesn't just stay trapped in the EV division. It is immediately applied to the next generation of the gas-powered Bronco, driving down costs across the entire company.
It is a phenomenal strategy, and understanding these underlying mechanisms, the reliance on high-margin off-road trims, the explosive recurring revenue of the Pro software division, and the intense effort to restructure EV manufacturing costs, that's the only way to evaluate this company properly.
Right.
Because Wall Street does not assign a stock multiple based on what you achieved yesterday. They price the stock entirely on what management can credibly promise for tomorrow.
That brings us perfectly to the forward-looking metrics, management guidance. Despite the headwinds, management came out swinging and actually raised their full-year adjusted EBIT guidance.
They did.
They are now projecting an incredibly robust range of $8.5 billion to $10.5 billion for the year.
And when a company raises guidance, you have to look closely at which segment is pulling the weight. Sherry House clarified that they are essentially pulling through about $500 million of underlying unexpected operational strength from the first quarter directly into the full year guide.
Okay.
And this strength is almost exclusively driven by the Ford Blue segment, whose standalone profit guidance was aggressively bumped up to between $4.5 billion and $5 billion.
But the talk tickers methodology requires us to look at the macroeconomic baseline management is using to generate these numbers. Their guidance assumes a U.S. SAAR of 16 to 16.5 million units.
Right.
Let's translate SAAR for the listeners. It stands for Seasonally Adjusted Annual Rate. This is essentially the automotive industry's best data-driven guess at the total number of vehicles across all brands that will be sold in the United States this year. A SAAR of 16 to 16.5 million indicates a healthy, stable, normalized consumer market.
Crucially, though, alongside that volume metric, Ford is explicitly assuming a macroeconomic environment with flat industry pricing.
Right. Meaning they are betting against a brutal industry-wide price war. They don't believe consumer demand will crater to the point where every automaker has to slash MSRPs and offer $5,000 cash rebates just to move metal off the lots.
That assumption is the absolute bedrock of their $10.5 billion profit target. But hitting that upper threshold is going to require navigating an incredibly violent tug-of-war on the balance sheet. Management laid out the puts and takes for the remainder of the year.
Okay, let's hear the tailwinds first.
On the positive side, they are projecting a massive $1 billion reduction in material and warranty costs.
Wow. Warranty costs have historically been a major pain point for Ford. They have struggled with recalls. If they can improve their initial manufacturing quality so vehicles stop breaking down and requiring free dealer repairs, that is $1 billion that flows straight to the bottom line.
Furthermore, they are modeling in the $1 billion expected net improvement from the Novelis recovery we discussed earlier, assuming the hot mill restarts flawlessly in May.
Okay, so we have $2 billion mapped out in the positive column. But then we look at the headwinds, and the macroeconomic reality gets very grim. They announced a staggering $2 billion in commodity headwinds for the year.
Yeah, that's a tough pill to swallow.
And we need to be explicitly clear here, because a Wall Street analyst specifically demanded clarification on this during the call. This $2 billion headwind is entirely unrelated to the localized Novelis aluminum disruption.
That is a vital, slightly terrifying distinction. This $2 billion is driven by global macro-level supply constraints in raw aluminum and steel pricing.
Just systemic issues.
Exactly. It is a systemic pressure affecting the entire industrial sector, heavily exacerbated by escalating geopolitical tensions in the Middle East, disrupted shipping lanes, and general tightness in the global supply chain.
And on top of that $2 billion raw material spike, they are budgeting for an additional $1 billion in ongoing tariff costs. Think about the mechanical reality of this. Ford is operating like a marathon runner on a treadmill that someone keeps incrementally speeding up.
That's a great way to put it.
They have to forcefully execute $1 billion in operational efficiencies and warranty savings just to offset half of the new raw material costs slamming into them from the global market. They are expending massive amounts of corporate energy just to tread water financially.
It is a precarious balance. And yet, despite these intense day-to-day margin pressures, they are continuing to pour jaw-dropping amounts of capital into their long-term infrastructure. They guided for $9.5 billion to $10.5 billion in capital expenditures for the year.
And CapEx is the lifeblood of an industrial company's future.
Right.
It's the cash explicitly earmarked for buying, upgrading, and maintaining physical assets like new robotics, stamping presses, and factory expansions.
Right.
But what caught my eye is that $1.5 billion of that massive CapEx budget is being diverted towards something completely outside their traditional business model. They are essentially launching Ford Energy.
This was easily the most fascinating forward-looking reveal during the Q&A session. Ford Energy is a brand new stationary battery storage business. They are committing to building over 20 gigawatt hours of storage capacity with a target launch in the fourth quarter of 2027.
We really need to define this because we are not talking about the lithium-ion batteries that go inside a Mustang Mach-E. Stationary battery storage refers to massive industrial-scale DC blocks.
Yeah, huge installations.
Picture shipping containers filled to the brim with high-density batteries designed to store immense amounts of electricity for the broader utility grid or to serve as primary backup power for massive commercial logistics facilities.
Right. And they plan to manufacture these industrial battery blocks primarily utilizing the footprint of their Kentucky One plant and their new Marshall facility. Jim Farley noted that the catalyst for this isn't just a random pivot into utilities. They are already fielding intense inbound demand from their existing Ford Pro commercial clients.
The synergy there is obvious. If I am the CEO of a massive logistics company and I already trust the Ford Pro software ecosystem to route my vehicles, and I trust Ford mobile mechanics to maintain my fleet, trusting Ford to supply and install the massive stationary batteries that power my distribution warehouses is the logical next step.
It really is.
They are actively trying to capture the entire energy and logistical spend of their enterprise clients.
It represents a massive diversification away from the low-margin business of merely bending metal.
Speaking of the macro picture and diversification, we have to look at how Ford is navigating the incredibly complex global chessboard. Jim Farley made some very pointed, strategic comments regarding geopolitics during the call.
He certainly did.
And to you, the listener, our job here isn't to take a policy stance or evaluate the politics, but purely to analyze how management's posturing impacts the underlying strength of the stock. Farley was directly questioned about the existential threat of the Chinese automotive industry, specifically the potential for heavily subsidized Chinese EVs flooding the U.S. market.
His response was highly calculated. He didn't just frame it as an economic competition, he framed the issue squarely around U.S. national security.
Which is a strong move.
Very. He deliberately referred to Ford's legacy as the arsenal of democracy, and stated that safeguarding the U.S. automotive industrial base is a matter of critical national defense. He pointed out the reality that countries like China, Japan, and South Korea utilize aggressive policies to protect their domestic auto industries, and argued that the U.S. must enforce a level playing field.
To back up that rhetoric, he casually mentioned that Ford is currently engaged in early high-level discussions with the U.S. Pentagon regarding defense-related projects.
Right.
He declined to offer specific technical details, but the implication is clear. Ford is positioning itself as an indispensable anchor customer and a critical partner for the federal government in the massive effort to onshore the mining of critical minerals and to secure domestic manufacturing for battery cells and semiconductor supply chains. If they intertwine themselves with the Department of Defense, they secure a massive moat around their domestic business.
However, they are a global corporation, and they still have to fight for market share internationally, which requires a completely different strategy. While they are wrapping themselves in the American flag domestically, in Europe, they are actively pursuing a deep partnership with Renault for passenger cars.
Why Renault? Why partner with a European competitor?
Because the European regulatory environment demands incredibly cheap, efficient EVs right now, and Ford's internal platforms are currently too expensive. Renault has developed highly cost-competitive, next-generation EV architectures.
That makes sense.
Rather than spending billions developing a bespoke European platform, Ford is leveraging Renault's engineering to instantly field competitive vehicles against the influx of cheap Chinese OEMs in the European market. Simultaneously, they are maintaining a highly successful joint venture with Volkswagen to co-develop commercial vans and mid-size pickup trucks for the European sector.
It is a masterclass in geopolitical hedging. They are fiercely protective of the U.S. market, aligning themselves with the Pentagon and domestic supply chain security, while concurrently relying on strategic alliances with legacy European competitors to defend their overseas market share.
Which brings us to the ultimate point of this analysis. We have applied the talk tickers methodology, we've admired the shiny revenue numbers, and we've crawled under the hood to expose the novella supply chain leaks, the macroeconomic commodity headwinds, and the hidden power of their software growth.
Right.
Now we have to synthesize this into an actionable thesis. What does this transcript actually mean for a retail investor's portfolio?
It is time to make the call. Based on the data, the guidance, and the hidden asterisks, is Ford Motor Company a buy, a hold, or a sell?
Well, if you force me to take a firm position, my stance is this. The underlying operational metrics of the first quarter were incredibly strong, proving the core business is highly resilient. The fact that Ford is consistently beating its Detroit competitors on F-150 average transaction prices, while simultaneously requiring the lowest incentive spend, demonstrates supreme pricing power. Furthermore, achieving nearly 900,000 paid Pro software subscriptions proves that their strategic pivot toward high-margin, recurring software revenue isn't just an empty Investor Day buzzword. It is materializing aggressively on the balance sheet.
So it's real.
It's very real. If you look purely at the momentum of Ford Pro and the profitability of Ford Blue, the stock looks undervalued.
But I have to interject with the bearish caveat here, because the downside risk is massive. The $10.5 billion guidance management is projecting relies on a dangerously flawless execution in the second half of the year.
It really does.
If that Novelis aluminum mill restart encounters even minor mechanical delays past May, or if the production ramp-up is sluggish, Ford's profit margins are going to be instantly pulverized as they continue hemorrhaging cash on emergency air freight and spot market alternative sourcing.
The execution risk cannot be overstated.
And if global steel and aluminum prices spike even slightly further due to escalating tensions in the Middle East or additional shipping blockades, that projected $2 billion commodity headwind could easily balloon to $3 billion, wiping out their operational gains entirely.
Exactly.
Most importantly, a $777 million quarterly loss in the EV segment is an incredibly heavy anchor. Right now, the massive profits from the traditional gas and hybrid trucks are dragging that EV anchor forward. But if consumer demand for traditional trucks softens, or if interest rates push monthly payments out of reach for the average buyer, that EV anchor is going to drag the entire corporate ship underwater.
That perfectly encapsulates the risk profile. So here's the actionable advice. If you currently hold the stock, or if you are considering entering a position, you need to view the balance sheet as your primary security blanket.
What's on the balance sheet that helps?
The company is fundamentally well capitalized to weather these storms. They are sitting on $22 billion in pure cash and over $43 billion in total liquidity. During the quarter, they successfully renewed an $18 billion corporate credit facility. They repaid a tranche of convertible debt with cash rather than needing to refinance it at higher rates. And they executed an anti-dilutive share repurchase program to offset executive compensation.
To translate that into Talk Ticker's plain language, they are hoarding a massive pile of emergency cash, and they are managing their debt structure with extreme discipline.
Because of that rock-solid financial foundation, they are comfortably maintaining their regular 15-cent per share dividend for the second quarter, which is payable on June 1st.
Nice.
From an investment perspective, if you buy or hold the stock today, Ford is paying you a very respectable dividend yield simply to wait out the turbulence of their EV transition and the Novelis supply chain crisis.
If I am an active investor tracking this position, what are the specific actionable metrics I need to monitor over the next 3 to 6 months to know if the thesis is breaking down?
First, do not get distracted by the noisy month-to-month retail EV sales numbers that dominate the financial headlines. The true health of this company rests on two critical, albeit less glamorous, pillars.
Okay, what's pillar number one?
Number one, you must monitor the automotive trade press to see if the Novelis plant successfully restarts on time to supply Q3 and Q4 production. If you see any news reports hinting at further aluminum shortages or extended downtime at Ford assembly plants this summer, that is a glaring red flag that their guidance is in jeopardy.
And number two?
Number two, you must track the growth rate of Ford Pro. Can they maintain that 30 to 40% year-over-year growth in digital subscriptions and mobile service revenue? If that software adoption stalls, the entire long-term thesis of Ford transitioning into a high-margin services business takes a devastating hit.
We have inspected every inch of this transcript. We've checked the foundation, evaluated the cash flow, and mapped out the supply chain risks. But as we wrap up this deep dive, I want to leave you, the listener, with a final, slightly provocative thought to mull over.
Oh, I am intrigued.
Consider the massive underlying transition we just spent the last hour outlining. Ford is aggressively expanding a fleet of mobile mechanics to capture out-of-dealership repair revenue. They're rapidly scaling an enterprise fleet logistics software platform powered by AI predictive routing. And they're investing $1.5 billion in Ford Energy to build gigawatt hours of industrial stationary battery storage for the broader utility grid.
Right.
These are all high-margin, sticky, anti-cyclical service segments growing at nearly 8% annually.
It is a complete structural departure from the last century of their history.
Exactly. So here's the question you need to ask yourself as an investor. If management actually executes this pivot over the next 5 to 7 years, at what point in the early 2030s does Ford stop being valued by the market as a cyclical, low-margin metal bender?
Wow.
Right. At what point do Wall Street analysts look at the recurring revenue on the balance sheet and realize, wait, this isn't just a car company anymore. This is a high-margin enterprise SaaS provider and a localized energy utility company that just happens to utilize commercial transit vans as the hardware delivery mechanism?
If the market genuinely begins to view them through that lens, it would necessitate a complete rewriting of their valuation models. A traditional automaker trades at a price-to-earnings multiple of roughly 5 to 7. A dominant software or services business trades at a multiple of 15 to 25.
That's a massive difference.
Huge. If Ford can prove that software is their true engine of growth, the upward re-rating of the stock price would be historic.
And it all comes down to how you choose to view the investment today. Are you just staring at the shiny paint job and the horsepower of the new F-150? Or are you looking under the hood at the millions of lines of proprietary software code and the industrial battery blocks that are actually going to power the profitability of this company tomorrow? Thank you for joining us on this deep dive. Keep questioning the headline numbers, keep digging into the raw data, and we'll see you next time.